I'm Candace Hughes. Thanks for tuning in to Get Wealthy Arizona. I'm here with Denver Noahs. Denver is one of the top insurance and financial services professionals in the nation. Welcome, Denver.
Nice to be here today, Candace.
Denver, we've survived the elections. We've survived all the soothsaying about the fiscal cliff. We're on the other side of it now, and we're looking at some significant tax changes for some people. Can you give us a little feedback on what you think are great strategies for them?
Well, I think it kind of brings up the question, too, as we get into tax season again, of a very similar question that I've always been talking about, is the ability of comparing the advantages and disadvantages of tax deferral versus, paying your taxes now and creating tax-free income. Part of that is knowing that, what happens when people are looking at in those high income brackets, again, their taxes are going up. So what people are going to be talking to them about often is these things like, maxing out the 401k plans, maxing out the defined benefit plans to try and defer the taxes till later on. And the important thing to know about 401ks, SEP plans, defined benefit plans, is that they are not a tax savings plan. They are a tax deferral plan. So that means you're going to pay the taxes, just not right now. You're going to pay them later. And so that's not to say that we don't ever set up those types of plans, because we do. But what we do differently is we're always having part of the conversation is, well, look, you're going to have to pay your taxes. Do you want to pay them now or later? Do you want to defer them and just pay them later on? Do you want to pay them now and get them out of the way? When you get down to retirement, do you want to have your income being tax-free, or do you want to pay the taxes then? And so as long as those questions are part of the conversation, that's a good thing, because people aren't necessarily often told the other side of that story. As an example, what we'll see is in executive groups or highly compensated groups where they're maxing out a defined benefit plan. Maybe they're putting $100,000 a year into a defined benefit. So what happens is the advisors and the people that set it up come in and say, hey, this is great. You don't have to pay taxes on $100,000. Saves you a lot of money, and let's invest it and everything. Everybody's happy. The other half of that, though, is now that $100,000 is going to grow. You retire, and there's that. Now it's grown to $200,000. Now you owe taxes on $200,000 instead of the $100,000. So a better strategy is to come in and first have both sides of that conversation. Look, tax deferred is tax delayed. It's not a tax savings. It means you can delay paying those taxes till later. So instead of just delaying all the taxes and paying them all, kicking that can down the road, let's take a more balanced approach where you're going to put half your money in defined benefit, and then you put the other half in a tax-free position. So now when you get down to retirement, half your income is coming out taxable, but the other half is coming out tax-free. And that can save you, 50, 60% a year in taxes, for those high income earners, and that can add up to, $500,000 or $600,000 in savings over the course of retirement.
It sounds like a great strategy, but, let me play devil's advocate here. If somebody were to tell me, okay, you have $100,000, which I would be happy to have to invest.
Yep.
But I have to pay the tax on that $100,000.
Right.
I would think of that as a huge expense to myself right now. What would happen if, for example, I were to pay the tax out of that $100,000 and invest the remainder instead of having to spend a higher amount to do that? How would that affect the outcome?
Yeah, so that scenario you're looking at is, so if I can save the money on the $100,000 and put it in there, I get $100,000 to invest. As the alternative, I pay the taxes now, and now I'm going to invest with $70,000 because I paid the taxes on it. There's a couple ways that you do that in executive bonus and what's called Section 162 executive bonus and executive compensation, where you might have a group of 5 or 6 attorneys, and what will happen is they do a bonus plus a double bonus. So the company pays the $100,000 goes into the executive as their bonus, and they also bonus the taxes and pay the taxes on the money. So now you're able to actually investing the same amount of dollars. But even if you don't, in the other scenario where you end up putting that $70,000 to work, where on the other side, as you mentioned, you're investing $100,000. Now you get down to retirement. On the first scenario, your $100,000 has grown to $200,000, but you owe 30% in taxes on it. So now after you pay the taxes, you have $150,000. And on the alternative, your $70,000 has grown to $150,000, but it's tax-free. So what it is, it's the same money. So in that best case scenario, it ends up being a wash, if that makes sense. You end up either paying the taxes now or you pay them later. It doesn't matter that you're investing less, because even if you're investing more, you have to pay the taxes. You have to pay the IRS when you get down to retirement. So it ends up being a net kind of no advantage to it. So there's really, for a lot of people, there's no advantage to tax deferral. Even though they're putting less money away, they're just going to pay the taxes down the road. And if taxes are higher, they end up paying more.
You always hear, though, that you're going to be in a lower tax bracket. And that's the reasoning that everyone tells you why you want to defer those taxes until later.
Right.
Compare that and give us the bottom line on how that really works.
What tax bracket you're going to be in retirement very often depends on how much money that you spend. So if your studies kind of tend to show that people that are spending $75,000 to $100,000 a year tend to spend around 85% of what they spent at pre-retirement level. So whatever you're spending now, if you're in that $75,000 to about $100,000 range, you're going to spend about 85% of that in retirement. Once you get into like the $120,000 a year incomes and above, they tend to spend very close to what they spent prior. So if someone is making $250,000 a year right now, they're going to be spending close to that in retirement based on, you know, a lot of the studies that we've seen. And so it's not always the best thing to, again, you look at delaying those taxes, you know, thinking that you're going to be in a lower tax bracket. But what happened is when the 401ks came out and the deferred compensation plans came out in 1978, 1980, around that time, they were designed as executive compensation because there was 16 different tax brackets at that time in the U.S. tax code, with the highest bracket being 70%. And so then there was a 68% bracket, there was a 66, there was a 62%.
Outrageous.
Yeah,
really.
The brackets were very small. So the idea was that, hey, if I'm an executive at 70, and I'm in a 70% bracket, then I can defer my taxes and maybe I'll drop into a 60%. But now what's happened is the brackets are so broad that most people are going to be solidly in, you know, if they're in a 28% tax bracket now, they're going to probably be in a 28% bracket when they retire and so on. So,
especially since taxes may be going up.
Especially since they may be going up, and then just also because the brackets are so broad. You know, people tend to stay into those, you know, 28% brackets if they're in it now. And that's when you're looking at incomes of $75,000 and above.
Right.
You know, when you get down below that, you know, there's all the, you know, the subsidies and everything else. So those groups that are making less than that aren't paying a whole lot of taxes anyway. So you look at the tax deferral strategies a little differently there. But when you're making those higher incomes, it's you got to look at those numbers a lot more closely. And very often it's not like, hey, we're going to eliminate, you know, putting money into 401k or a separate defined benefit. But we're going to make sure we're just going to look at the overall number you're saving and to say, all right, half of that can go into tax deferred accounts and the other half we want to go into tax free accounts. And that way, that balanced approach of having half your income coming out taxable and half it coming out tax free, even at someone that's maybe making $75,000 a year or wants $75,000 a year in retirement income, it'll reduce their tax liability in retirement by 80-90%. So it's a huge tax savings by splitting it up.
Truly, I can imagine that the tax burden at that level is pretty high anyway. So saving 80 to 90% of that is very significant.
It's always bigger than people think. I hear people all the time saying, don't worry about your taxes in retirement. They're not going to be that much. Then you start talking to retirees and they go, man, my taxes are really hitting me hard. So the video series we have goes into detail about that. You can see charts and graphs on how executive bonuses work and the difference also between just the basis of tax deferral versus paying the taxes now, because you brought up a good point, the question of, okay, well, now if I pay the taxes, I'm investing less. And even in that scenario, it still works out more favorably often to pay the taxes now. But the videos are a good first step on that.
Great. And you can get a copy of those if you'd like. Call 480-970-5663, 480-970-5663. You can request a copy of those videos. They do email those out, so just give them your email. They'll send them out, and you can take a look at the information, compare it, see if it's something that you think would work for your situation.